All right, today we're in one of my favorite sections, talking about Chapter 5, Lesson 3, talking about the cost, revenue, and profit maximization. So basically, how does a business do well? How do they succeed? So go through some ideas here. The first thing is going to be talking about the idea of fixed costs. And this is the cost an organization incurs even if there's little or no activity. These are the bills that you're going to pay no matter what. It does not matter how much the businesses produce. Sometimes it's called the overhead. It could be examples are salaries to pay to executives, rent, property taxes. It includes depreciation. My best way to say this is think about it as if you're a restaurant and you're open 7 days a week and you decide to close Monday because it's the slowest day of the week. That day, no matter what, you're still going to have to pay your bills. You're still going to have to pay your electric, your water, your sewage, your trash. Everything that you're going to pay, you're paying out, but you're not bringing any money in. That's what a fixed cost is. So it's all the money that you're going to pay no matter what happens, whether you're crazy busy or you're darn slow. The next thing is variable costs, and that's the cost that change whenever the business rate of operation or output changes. This is examples could be labor and raw materials. So this is going to be, how we use if I have a very busy day and I schedule extra people, then I'm going to have much more labor used. Now, obviously, I'm going to offset that because of the cost of my sales. It's going to look at it from a different perspective. So I'm going to show you real quick here. I'm going to add another slide just because it makes a little bit more sense to me right here. So just give me 1 second, I'm sorry. So what my example are, these are just kind of generic rules, how I look at it from a budget perspective. The first thing I would say is if you're looking at a restaurant, for instance, so let's say your restaurant does $10,000 a week in sales. Well, how do you know if you're making money? All right. The first thing I'll say is you have to have a budget. Some people call it a P&L, which is a profit and loss. You have to have an operating account that says this is how much I'm going to make. So most businesses are structured off of a model. I always call it the 30-30-30-10. And what that equals out to is 100%. That gives me an example to show me what type of business structure I'm having. Now, this is, again, just a model. It's not precise. But what this means is whenever I look at this $10,000 figure, 30% of it needs to be my fixed costs. Meaning if I sell $10,000 worth of product this week, 30% of that could go to fixed costs. Can go to. I don't want it to be 30%. I want it to be much lower, ideally. But 30% of those fixed costs are going to be there. So that's going to be your fixed expenses like rent, equipment maintenance, things that you have to do no matter what. The 30% is going to be for labor. Again, based off of a sales of $10,000, I want to have only up to $3,000 in labor if I sell the $10,000. So $3,000 in labor and $3,000 in fixed costs. Sorry, this is typing very slow, just because I'm probably recording here. The next one is going to be the cost of your goods sold. In retail, we call it COGS, and COGS stands for costs of goods sold. So that's how much do I pay. So for instance, if I'm selling burgers, and I'm selling $10,000 worth of burgers, if I'm selling and I'm pricing things correctly, then I should never have over $3,000 in costs of my goods. So what happens is, if I'm working in this business and I'm looking at it, I have 10% left for profit motive. Now again, that is just a threshold of an example. Idealistically, I want to make more. But what this looks like is if I pay all my fixed costs, all my labor, and all of my goods, if I had a $10,000 week at the restaurant, I should be able to take home or pocket $1,000 in profit. Now again, this does not take into account advertising expenses. This does not take into account management overhead, fees of that nature. Again, they can be budgeted within these different lines. But idealistically, if I have a budget, I should be able to take home at least 10%. Some places are going to work on higher margins than other. Margins or the marginal cost is, how much do I make compared to what I paid for it? So if I have a really good week, like I have a $10,000 week, and I can get my labor down to $2,500, and I can get my cost of goods down to $2,500 through creative ways. Maybe I get stuff on sale. Maybe I hire a person who's just awesome. Then I'm going to have more potential to make profit. So eventually I can get this number up down here. Again, this is just a threshold model, and I'm using round numbers to make it look easier. But this is what every business has to look at: is will I do, if I make everything cost correct, if I create the correct revenue, what is my profit maximization? So, looking at it a little further, the total cost and total marginal cost is the fixed cost plus the variable cost. The marginal cost, on the other hand, is the extra cost incurred when producing one more unit of output. Additional cost of adding each worker divided by the additional output the worker generates. So, for instance, if I had my fixed cost of $50, okay, my total variable cost is 0. My total cost is 50. Now, if I add the other person or the idea on, my variable cost is going to go up. So my total variable cost is the fixed cost as a variable cost. The variable cost is, again, adding another person to it or adding other people to the mix. So what it's going to see is the total cost continue to add. And what you're going to do is you're going to take the additional cost of adding each worker and then divide it by the additional output that the worker is going to generate, meaning that if I add an extra person and I add all my extra sales, is it actually going to be beneficial to me? Will I make more money? Or if I keep putting bodies in it, is it going to actually make my product, my actual revenue or my margin on the revenue actually shrink? We'll show this again. I'll explain this a little bit further. So types of revenue. You have average revenue, which is the average price of every unit of output that you sell. The total revenue is all the revenue a business receives. So, like for instance, if you have departments, I go back to Walmart, we had food, we had consumable products, and then we had different departments. All those departments came together to create our revenue. It's everything that we bring in together. Marginal revenue is the extra revenue a business receives from production and the sale of additional unit of output, meaning that if we did something to change the way we look at things, how is that a change or that effect going to actually change our business model or our plan? So how do we find marginal revenue? Again, this chart is going to be in your book. It's the change in the revenue divided by the change in the total output of marginal product. So we have the 3 stages that we talked about earlier in the last section. So it was a number of workers. Remember, the stage 1 is coming up and doing well. Every time you add more, we're going to grow more. But stage 2 is kind of where you plateau. And then stage 3 is when it gets negative and when you actually have marginal product go down. Doing this, what happens is you'll have a total revenue. And the revenue is, what are we making from selling this product? So the total product is here. This is what the revenue is showing. So the marginal revenue is showing you that for each unit, it's consistently $15. So the total profit, when you look at and you're taking apart the addition of that marginal revenue, you're taking it and dividing it by the change in the total output, and that's going to create that marginal product. So the total profit here on the right side shows you you're going to lose money on the first one, you're going to lose money on the second one. You're only going to start making a profit once you have 2 workers who are able to produce the goods that the customers are asking. That's when you're looking at all the other variables that are coming in. So you continue to grow, and finally when you plateau up here, you realize that between 8 and 9, you have 8 people and 9 people, it brings 0 value to your company. So at that point in time, you have to make a decision to cut the labor, cut the force to make sure you're maximizing your profits. Any other additional bodies that you're adding to it, to the production, is actually going to cost you money. You're spending more money on things that you don't need. So profit maximization is the quantity of an output. It's the volume of production where marginal costs and marginal revenues are equal. So the marginal cost here at $15 versus the marginal revenue is $15. This is where it looks like we're having the perfect system, meaning that if your business is structured in a way that it doesn't adjust every day, this is going to be the profit maximization output for what you need. All right? That's covering all your overhead, all of your expenses.